Well, maybe it's the spirit of the times. We've got a small band of independent MPs wielding enormous power in Canberra. And with the AGM season approaching and some big remuneration packages to be approved, Corporate Australia is no doubt sweating about the growing influence of the very independent thinking proxy advisory firms. The proxy firms, with their zealous approach to corporate governance issues and armed with votes of institutional investors, have scored some significant wins over the likes of Telstra, Wesfarmers and Toll Holdings. Neil Woolrich takes a look at the growing power of proxy firms and why capital raisings and investment bank fees are now in their sights.
For the past 6 years, Dean Patch has been chipping away at the walls of corporate Australia as a director of the proxy advisory firm ISS. But these days, he's about to build a fence himself as he takes a career sabbatical.
We don't fire the bullets, we make them. I always think of us working for financial intermediaries, but on behalf of people who entrust their savings to them.
His resignation coincides with a period of relative calm between company boards and their sometime nemesis, the proxy advisory firms, who suggest to big investors how to vote on matters like the election of directors and executive pay.
The number of instances that we see of egregious behaviour on pay are few and far between. They've certainly come down a lot after the global financial crisis.
But that hasn't always been the case, with proxy advisors often getting a frosty reception a decade ago when they first attempted to improve standards of governance in corporate Australia.
It's the institutions, typically, that actually do the negotiations with the company. We're not in there saying, if you reduce this, then we will advise the other way.
Proxy firms are like the Australian Democrats, with the same sort of mission to keep us bastards honest. And I think they've achieved that mission pretty well over the last few years, where they've become consequential.
I think there's empirical evidence to demonstrate that good governance improves corporate earnings, and they have a role to play in that regard.
There's a greater independence of audit committees. There's greater attention to the formation and the work of nominating committees so that you get good directors appointed and good directors selected for the future.
Michael O'Sullivan has feet in two camps as president of the Council of Super Investors, a proxy advisory service, and as chairman of Care Super. While he agrees progress has been made on governance, executive pay remains the key issue.
Some of these remuneration policies are so complicated that they take quite a lot of unravelling, and you have to make sure that you understand them. And we've had occasions where chairmen have come to meet with us and admitted that they couldn't understand them either. Now, I think that's a very bad situation to be avoided and changed.
Bris Connections and UGL chairman Trevor Rowe says proxy advisors have definitely played a positive role in the corporate governance debate. But he worries about the practice of criticising directors when it's not clear which individual is responsible for particular company failings.
I think that's a very dangerous development, to start forming opinions about directors based on past roles, because there could well be situations that are not evident or not publicly available, but are not evident to the market out there, and so consequently these judgments might well be called into question.
My own experience with proxy firms is that they do not have a good understanding of the way corporate boards work. And perhaps none of our various stakeholders really do understand that. So to offer an opinion about the effectiveness of a particular director is a bit of a reach.
Proxy advisors have also been criticised for lacking expertise in certain areas, like judging levels of pay or fair value in a big transaction.
I think they do have a role in identifying any unusual aspects that may impact value or impact on shareholders' rights, not in terms of forming views or judgments relevant to the value outcomes.
We don't second-guess valuation issues lightly at all. We've only recommended against 6 transactions on economic grounds, but it's really only where the structure of those transactions or the disclosure or the valuation methodologies are open to scrutiny.
But Axie's Michael O'Sullivan says criticism of proxy advisors can often be misguided, including a shoot-the-messenger reaction at times.
Which I recall happening at Telstra when they got a 66% vote against their CEO remuneration package. They blamed Brismetrics and others for recommending against the package. But within a year, they'd reformed the package.
The next big corporate governance battle in Australia could well be over the way companies raise money using share placements. Almost $100 billion was generated this way during the global financial crisis. But existing shareholders often saw their ownership diluted as others were given preferential allocations at deeply discounted prices.
We believe that whilst placements are absolutely required in some instances, that there should be fairness and openness so people's preemptive rights are respected. And where anyone's ownership interest increases as a result of receiving a placement, that be disclosed.
They couldn't get their money any other way. You couldn't borrow money. So you had to raise equity and you had to raise it fast. And so a few of the old niceties, I think, were pushed aside.
ISS has found that investment banks in Australia earned $2 billion in fees from capital raised during the financial crisis, a 2% levy at very little risk. Dean Patch says greater transparency is needed to show who gets what shares in a discounted placement.
That will enable investors going forward to price in the risk of getting ripped off either by boards who aren't very good at doing capital raisings, or their advisors who may be revealed, we don't know, who may be revealed as having a systematic track record of preferring their hedge fund clients or their prop trading desks at the expense of, say, Australian super funds who've been long, loyal shareholders.
But as Dean Patch steps away from the corporate governance business, he warns that the industry as a whole remains understaffed and underfunded, with companies willing to spend more on public relations to spin their way out of trouble rather than fixing problems before they cause major damage.